Right. There's a few people coming in still, but we're gonna get started in a second. All right. Let me just make sure. Share the screen. Sorry for the technical issues. I'm just making sure we're just mute everybody. Okay, very good. I hope everybody can see me and hear me well. And I hope everybody is well and healthy. We're going to start the meeting as every week. I'll do an overview of the macro as well as the strategy. We'll have time for questions as well. And if you have any questions, please put them in the chat. I will discuss them. I'll review them in detail. And for those who are not familiar with the strategy, I always like to start by putting things in perspective of the portfolio construction, having in mind the view that this is a team where you're the coach, you decide the strategy, you decide, you have a number of very important jobs, which includes how you want to play the match, strikers, midfielders, defenders. You obviously need to pick the players, and I think it's important that each player does its job, and obviously you need to rotate, also take profits, accumulate, and compound. Ultimately, the goal, as I understand it, overall, is a game of capital preservation and compounding as a team level. And obviously to the best possible, also at the individual pieces, bearing in mind each one needs to do their job, and you expect the strikers to score and the keepers to save. With that, when we think about the portfolio, and also touching on a very important point, the false diversification, we've seen during crisis. March 2020 looks and feels like a distant future, just a little bit over a year away, but it was a very distressed period where volatilities exploded, and also correlations polarized. At that time, correlations went pretty much +1 across many assets. We did particularly well through that period. It's been very challenging since the summer, and it's somewhat a bit of a mirror image of, in some ways, of what's been happening on some of the risk markets, where, as we can see in orange, we have basically all-time highs on the S&P and other markets such as gold or treasuries under meaningful pressure. In that sense, looking at the portfolio construction, what makes a striker a striker? What makes a goalkeeper a goalkeeper? What does it mean? This is an exercise, in our view, that is behavioral. Is about behavior. It's not about labels, and so it's really about how you do. What are those key factors for goalkeepers? One of them is volatility. We have perhaps inflation emerging. We have certain things that will determine what makes a player. What's the job? How is it performing? Clearly, on the risk side, the participation to equity markets, to growth, etc. So equities, in my opinion, relatively clear strikers, and volatility, the VIX, for example, a clear goalkeeper. The midfielder being more correlated. I want to touch on two key points on the portfolio construction, and related to this, one is volatility. And I talked a lot about the meltdown scenario. We are in a bit of a melt-up scenario at the moment, which is the mirror image. But the melt-up scenario or meltdown it touches on the relationship between volatility and prices. And what we've seen in those previous crises is how when volatility increases, whether it's realized or implied, I like to refer to volatility as the speedometer of the markets. And the perception of risk, if you're running at 300 kilometers an hour and the speedometer says 80, when you crash, you really feel the real speed you were running, regardless of what the speedometer said. And volatility is a little bit of the same in the sense that when you might have artificial low volatility, both realized and implied, but ultimately the real risk is whatever you're running. And when this takes off, and things start to move, the increase in volatility drives effectively deleveraging. People, whether you're a day trader or a pension fund or whatever, are in a way being forced to reduce. Forced liquidation takes place, and as you go into crowded positions and you start facing liquidity, you might have a triple whammy of lower volumes, difficult to get price and to get things done in time, which as it happens with forced liquidation, then it can actually compound the problem and contributes to not only volatility going up, but also correlations polarizing. And this is a situation that compounds into value at risk, which goes up exponentially. And this is a mechanical process that explains why the market can go so much further than we could have anticipated, and actually feeds on itself. And I talk a lot about this, but there's a mirror image of this situation, which is the melt-up scenario in a way. If you think about, in my view, the bubble anti-bubble framework, we see there certain scenarios where the volatility spike has contributed to this process that I've described, with the collapse in March being accelerated and exacerbated by vol. But look at where we're now. And the break of volatility below 20, in my view, is seriously contributing to this wave of buying that is, as we'll see later, now into deeply overbought territory, and whereby this dynamic of volatility is a bit of a double-edged sword. So the massive pickup in volatility brings this turbulent regime which forces liquidation. On the other hand, as volatility collapses, both implied and realized, as volatility goes, and we've seen the VIX printing 16 or so recently, what you see is that there's a lot of players such as trend followers or vol targeting or even risk parity that actually are in a way being forced or dragged into buying more. So I would argue that some of the buying that is taking place is happening reluctantly. It's happening despite these massive high prices. Not everybody here is super bullish. I think the models and the systems are doing that, and this is, as I say, the other side of the volatility. And this is, I tend to say that volatility is cheapest when you need it the most. Well, buying the VIX at these levels is the cheapest it's been in a while, and arguably this is the best level because you have the most value to protect. However, it's actually being long the VIX or playing the VIX is extraordinarily difficult and painful because of the carry. What you see here in white is the spot index in the VIX, which is what most people look at. And yeah, this is what you expect to receive. The reality, unfortunately, is different. If you were long the VIX futures and you are long and rolling those futures, what you earn is more the gray line. So the gray line shows you the VIX ETF, and we see that this is not a random period, it's a period since Igneo started, approaching 3 years. We see that the actual ETF, despite the VIX being up as an index, as a snapshot, the actual investments in the VIX would have lost about 68%. It's a big loss, and this is driven through this extraordinarily painful negative carry, which is a little bit structural to the insurance market, but is very exacerbated in the case of the VIX. This is how we explain this. This is effectively a snapshot of different curves of the VIX futures. And in green, you see the shape of the curve pretty much about a year ago when the VIX, the market was under pressure, the VIX was going up, and the market was telling you that it was likely to be a very short-term volatility event. It actually went way farther than that. It went to the 80s levels that we haven't seen since Lehman. And that term structure, that massive backwardation that you see on the left-hand side, this backwardated curve, it's almost like a coiled spring that explodes higher. What we've seen in the last few months is the development of a super contango curve, and what it means as you buy the future and then the market rolls down is that the carry is in the region of 10% negative per month. So trying to be, whilst the VIX is an incredibly important anti-bubble, and it's one that we believe is partially for these reasons one of the best things to own in a crisis, is extraordinarily painful to hold or to own while you wait. And in that sense, this is something we need to balance very carefully, and part of the reason why you need to be a little bit tactical with respect to when you step in. And we have been stepping in. We did it successfully into March last year. It's been painful for us over the last few months. There are different ways to express this, as we discussed, but it's a challenge. I made my point. Insurance is cheapest when you need it the most, but you need to be mindful of the carry, and this is very, very painful. If you look at the term structure, we looked at it. It's in steep contango. What you see here is a snapshot of the options for options expiring in a little bit over a month. And what I want to show you is the massive call skew. So in terms of volatility, you see that the at the money-ish volatility is high, is in the 80s, but 80s or 90s. But what you see is that if you try to buy options that are out of the money, the implied volatility for those strikes is super high. We're talking about a $40 call with 155 vol, which is quite pretty much double the volatility of the at the money, and this super high contango and this massive cold skew, it's a reflection of flows. Obviously, when the market goes crazy, you want to own this stuff, but at the same time, it makes it very challenging. And part of the reason why we have been long through cold spreads, because you buy the closer strikes, you try to monetize the upside, the odds of giving up the blue sky, the premium decreases, the carry decreases. Nevertheless, you may still lose your premium. But I want to show you how tricky is and how painful is to play the VIX, whilst again is one of the team players you want in your team is a major consideration. With that, I want to bring the second dimension to the portfolio construction, which I think it's less understood. I mean, the volatility tells you, hey, yes, in a world that is quiet with volatility down, you want to be in risk assets, you can be in equities, you can be in emerging markets, you can be in commodities, but be careful, because when things go wrong and the markets go turbulent, you will need some defenders and ball keepers. What percentage of the time is the ball in one side or the other? How painful is one side or the other? Of course, if you're super levered, a scenario of a big correction and spike in volatility can take you out completely. We've seen Archegos this week, you know, how this gentleman lost, I don't know if it's 10 billion or 20 billion of his own wealth in 3 days, right? So that leverage and a little bit of volatility can expose some of these things, and that's what happens when you only have strikers in a levered basis, right? So the issue with inflation is it's critical. I think I've been talking about this for a long time. It's becoming, I think, the clear way out. You have tons of things to consider. We just had inflation numbers in the US, which have come not surprisingly higher than expected, and we expect inflation to continue to pick up, even if the official numbers are complete BS. CPI, the way many of these things might be computed in terms of the baskets, they don't contain many of the things that we need, you know, education, housing, health. So, and if these things go against them, then they will change it. So we know that the inflation is on the rise. You can see it with the naked eye. But even then, even with indices that are not, in my opinion, appropriately reflecting inflation, because, you know, all the people in this call have different inflation baskets. I mean, some of you or some of us might have kids in university, others have nappies, whatever. Our inflation basket changes, but the reality is that there are lots of things that are pushing. And this is beyond the liquidity, beyond the central bank blatant change of mindset and change openly. We've gone from 2% inflation ceilings to average inflation of 2%. And be careful what you wish for, but we might be seeing 3.5 inflation prints in the US. This is going to shake up a little bit the market. And again, these numbers are not even reflecting reality. So what this means ultimately, of course, there are lots of deflationary pressures in the system, but as I always say, inflation is not about the value of your house going up or the value of bread going up. It's about the value of the money with which you buy bread or you buy your house going down. And we've seen the money printing in the trillions being printed and spent and lent, and this is monetary inflation, which I think it's accelerating. So we are still in this phase one. I think as inflation expectations accelerate, we will see that it's a difficult thing to contain. Mohamed El-Erian wrote a great piece yesterday. A lot of people are effectively warning against this new stance in central bank policy from trying to be forecasters of the game. It's like, oh, we expect inflation to pick up, therefore let's react before so we contain it, to Clarida, saying clearly we're just gonna act when we see it. And this is a little bit like putting sun cream in the beach when you start feeling the burn. We all know it's too late by then, right? So a lot of people are very concerned about this process, and in my opinion, is clearly part of the game and the end game. And obviously this comes from the result of monetary policies without limits. This idea that you can actually print your way out of a problem, which I disagree. I don't think you solve problems. I think what you're doing, and I talk about this a lot, you're delaying the problem. You're kicking the can down the road in the form of inflation. The form of debt. You're transferring the problem from yourself to the neighbor through currency and trade wars. You're transforming the problem in the form of inequality and inflation, and eventually you're enlarging the problem. As my good friend Daniel Lacalle always says, if you solve problems by printing money, Zimbabwe or Argentina would be world's powers, right? And they're not, unfortunately for them. So in that sense, this dynamic of monetary policies without limits keeps going, and it feeds the other dynamic, which is fiscal policies without limits. And this is the idea that you can borrow your way out of a problem, which I strongly disagree again. It's again a generational debate. It's about kicking the can. It's creating problems that are bubbles that are too big to fail. And we've seen this take a whole new level with Biden, and it keeps going. Every other week, we seem to have another few trillion of money going into interesting things. But to put things in perspective, the response, as you might remember, in 2007 to the Lehman crisis required 700 billion, okay, of money printing in first instance, which was there to support the hole in the banks, and that was considered to be atrocious at the time. Now it's a drop in the ocean relative to what we're seeing. And this is money being printed, is checks, is everything. The whole tax situation and the markets is missing again. Obviously, we will need some sort of tax increases, but right now the market, the momentum, the pressure and the infrastructure and all these things are driving the sentiment and the narrative of the market. I love this prudent imprudence, as Larry Summers named it a long time ago, the prudent imprudence of just borrowing more, which obviously it's a no-brainer if you're a country that can borrow at negative nominal yields. I would do that too. I think countries like Spain borrowing at those levels, unfortunately, we all know it's not a reflection of our or the country's ability to repay. It's 100% artificial. And I think artificial is the word. Artificial interest rates, artificial volatility, artificial credit spreads, artificial everything, which makes this game hard because you can keep these things artificial for a long time. But ultimately, I think my view has always been that this setup, it's very positive for gold. I consider gold to be one of the key anti-bubbles in the system. My view remains. I've had people who were calling into today that I know want to talk in detail about gold, so I've added more on this. And whilst gold is well understood by many people, I think the case was strong already into the previous phases. I think the case for gold now is significantly stronger, yet we're seeing a major disconnect in the price action, which I think it's an anomaly and something investors should be taking advantage of. Clearly, you can't print real assets, you can't print gold, you can print equities, you can print debt, you can print crypto, you can print anything, but you can't print real assets. I think the role of gold as a central bank asset, as a reserve asset, it's gained a bit of additional traction recently with, and I'll talk about this shortly, with the purchases from Hungary. But I think the monetary and fiscal without limits are very supportive of the real asset nature, but gold in particular, I think, as the monetary asset of choice. So whilst every real asset will go up, as we're seeing, is not necessarily something that happens in parallel. And I think relative to other defenders, such as fixed income, I think gold is uncapped and has that more asymmetric upside. And I think with the framework of inflation, with currency and trade wars, I think it's again reinforced. And we've seen a significant cleanup on the investor positioning. Some of them just giving up, some of them reducing their longs, but also a significant number of volume going outright short, which we'll have to buy it back at some point. We'll see where that happens. A few pointers. Central bank, again, relatively quiet. In fact, net sellers overall, not because they're selling out the reserves, but because they, in many cases, they might be the avenue to sell on behalf of the gold miners. So they buy the gold from let's say producers, but the actual selling and buying of reserves. I want to highlight this Hungary's purchase because it's a big number. This is from last week. 63 tons of gold mean nothing to most people, but it's about 2 million ounces, and it's about $3.5 billion worth of gold, which it's just Hungary. It's about 2.3 times Tesla's purchase of Bitcoin, and we saw what that meant for Bitcoin. It's been largely ignored. I think those 3.5 billion that Hungary bought were sold by some people. Some people might have just been taken off longs. If those people were effectively fresh shorts, I can guarantee you that by the time they want to buy back those shorts, it's not going to be Hungary selling them that gold. Okay, Hungary has time on hands, as they call it now in the lingo of the new ages. They are solid holders. And so I think that we've seen Poland and others talking about this, China and others very quietly. Of course, a country like Turkey under tremendous amount of pressure on the currency we saw last month. And I think this is a very important point to continue. We're seeing, scenarios where emerging markets are under significant pressure with Brazil, with Turkey and others, which shows you the weakness of the system. A bit of a dollar strength is putting a lot of this at risk. And I think this, again, from the World Gold Council's website, just looking at some of the flows, the 2019, very strong year that contributed. We've seen, there's a strong correlation with some of these outflows. And I would argue that the European and US outflows on the ETF side, the holdings are still at acceptable levels. There's not been panic, but certainly there's been a meaningful reduction, which has contributed. In some cases, more notoriously, I don't know, just the top of my head, some of the Black Rocks or whatever, going neutral or flat or underweight or even short on gold. But it's notable to see that Asia is a net buyer even within this process. And as I said, I think importantly also the central bank community and in general, I think this is something that I expect to reverse. And what knows what the catalyst could be, whether it's a geopolitical event or it's just the correction of the markets, or it just happens by its own weight, which could be perfectly possible. I rarely show the technical picture, but I think it's interesting. What you see in this graph at the top is the price with the Bollinger or Bollinger Bands. What you see at the bottom is momentum, and then the color little bands with magenta color show you levels that are deeply overbought, oversold, like warning signals. And we see how the gold market has been under tremendous pressure at the very bottom of the Bollinger Band for a long time, with levels of oversold that we haven't seen in very long times. And we see also, when these levels of big oversold prints take place, we have seen actually significant rebounds in afterwards, such as this is a relatively short period of time, but this would apply also to longer. So I think the technical picture is constructive. The trend is for higher, and I'd like to call out and watch out for a beautiful number. If you like me, like number 7, 1777, I think is the level to watch. It was a massive support a while ago. It's now a big resistance. And I think if 1777 breaks, we might see shorts covering. And again, who's going to sell it to them, we'll see. But I think the options market and the short gamma position as volatility increases could accelerate and contribute. I talked about this before. I wrote this piece on Bitcoin bubble, anti-bubble. I've been invited by Jesse Felder to talk about this next week in his podcast. Obviously, at $60,000+ per Bitcoin, relative to gold, it's phenomenal. I hold my view that whilst Bitcoin has a lot of merit in many ways, I think it's largely a bubble. In fact, I believe it's 80% bubble, 20% anti-bubble, and there are lots of misconceptions that I discuss. To what extent this price action, the narrative is common. People buying Bitcoin are generally looking for, they have a problem with the dollar, they have a problem with inflation, they have a problem, they're looking for this new finance and decentralized things. Some of them might expect that they are completely out of the system and they may not be paying taxes and they can do whatever they want. I challenge many of those beliefs, which I think are misconceptions, including the scarcity value, the idea that Bitcoin is a great inflation hedge because there's only 21 million Bitcoins, when in my view, you can actually print 21 million cryptos. Either way, it's undeniable, the price action. Congratulations to all those who were making a killing. I think you should be perhaps taking some profits to keep some free cryptos, and I think there's an opportunity to accumulate on gold. With this narrative of inflation, this I showed last month as well, is the big disconnect between gold and every other commodity. Even if this last month, as part of the scares, we've seen oil making some large, strange moves, which again, the vol and the vol are a bit of a warning signal. And in that sense, again, I want yet another dimension in which one I think gold is out of whack. It's out of whack versus the dollar, it's out of whack versus inflation, it's out of whack versus other commodities, nominal yields, real yields, etc., haven, etc. So I remain painfully very supportive of gold, and I think these are opportunities to accumulate in smart ways. So with this overview of the team, the two dimensions being volatility, you need your strikers, defenders, and goalkeepers, but with the inflation hat on, which I think is going to be increasingly a major point into next decade, is we need to differentiate on the strikers between equities and credit. We need to differentiate in the midfielders between real estate or others and cash. And obviously on the fixed income side, I would favor also anti-bubbles to fixed income. As inflation goes up, corporate bonds or credit, cash, and fixed income are going to suffer a lot. So if you buy 30-year Telefonica bonds and that your 100 euros will pay you back 101 euro in 30 years, that 101 euro is going to buy you nothing. My opinion is that the value of the euro and dollar and everything else is going to be nothing. So the purchase power is being diluted. This is accelerating, and it's part of the reason why you need the team, you need the diversification, but you actually need those things that will be risk on and risk off, but you need to do it with long inflation bias. And that's why I would favor equities, real estate, and gold and volatility. With that, obviously, just to touch on the change in paradigm and COVID, and again, many of these points, this slide is actually pretty much unchanged since I first put it, I think, almost a year ago. But it's continuing to be reinforced. Major disconnect in the economy. To what extent is liquidity and debt resolving solvency issues? We don't know, but what we know is that it's relentless, and they've gone way farther than many of us would have anticipated. And I think the numbers of trillions that we're seeing are put in a test. I think with the benefit of hindsight makes a lot of sense, perhaps, but this is something that is not done. It will continue, and things will give in. I'm going to talk a lot about interest rates now, and this is critical as we look at inflation and what that means. But my view is that higher interest rates are science fiction. What the market is testing that is on the shape of the curve, which we'll talk about in a minute. I did say the virus would go, but MMT would stay. I think that holds. I would also believe that whilst you might have some deflation, you will have a stagflation, which I stand by. And I think that these artificial valuations, whilst they've gone way farther than I personally would have anticipated, I also think that they won't last forever, even if as inflation accelerates, this is a big factor that could contribute to at the end of the day, equities are in some way benefiting from moderate inflation, not from very high inflation. But it depends also on the margin. But the complacency, the fear of missing out, all these things are being playing out in a meaningful way. The dollar devaluation is reversed. It's a problem that is across the currencies. It will invariably lead to inflation and debt monetization. And I think volatility is here to stay. So, huge important point, critical to my macro view, is that the artificial setup that we have with artificially low interest rates has created bubbles that are too big to fail. And this transformation of risk-free interest into interest-free risk has massive implications, right? We have negative nominal yields, negative real yields, 60-40 balanced portfolios are no longer balanced. Any asset that is valued using discounted cash flows is discounting cash flows at artificially low interest rates, artificially low credit spreads, and look at the impact it has, right? A cash flow of $100 in 50 years at normal interest rates of 5% would be just under 9 cents. Now it's par. So this creates this huge issues with value versus growth, right? Anything that has any growth, any cash flow in 100 or 200 years will be very worthwhile, which again, it's to me a big fallacy and a big weakness of the entire setup, which is it's all artificial. So if the foundation is weak, if the interest rate setup is artificial, the second and third order effects are very dangerous, and the impact is precisely the bubbles. these bubbles being too big to fail. This being too big to fail means they're systemic. If we had a big move down in the equities associated with credit and others, the entire wealth effect would collapse, and basically we would realize that we haven't really solved problems. And I think this is something that the central banks know very well, and why this change in the way they are doing things is moved from preemptive inflation to let's see what comes. And I think that they're just not in a position to let these bubbles collapse, which again, it poses the question of the central bank put, can they really hold this forever? And that I challenged before, and I continue to do, because central banks and monetary policy and fiscal have limits, and things will give in. As I mentioned earlier, we are transforming and delaying and transferring the problem. We're not solving it. So I do believe that the monetary normalization of monetary policy is science fiction. Is even if we're seeing now a big move in long-term rates, this is happening without a move in short-term rates. And again, I think the market is a bit dislocated. Okay, so this entire process, let's look at what it means to interest rates. And I showed this last month. I think it's a graph that is incredibly relevant. Once upon a time, we had a flat curve in dollars at 5%. The Fed funds, the 2-year, the 10-year, the 30-year were all 5%. And that's the pre-2008 crisis, or 2007. Obviously, 2007, 2008 come, QE is introduced, short-term rates go to zero, but you see that the back end stays high. The market believes, the central banks naively, that the QE is going to be a short-term issue, a temporary issue. I'm not that naive. I think that once they introduce these measures as short-term, they always stay. But what we saw is with Europe moving into negative interest rates, that steepness of the curve actually narrowed significantly. We saw pressure in rates, long-term rates going down. At one point, kind of enough was enough. The Federal Reserve, after a decade of monetary policy, incredibly loose, decides to tighten things up. And the curve moves somewhat in parallel. It gets to a point where the short-term rates go up to the level where long-term rates were anchored, and at around 3%, the world blew up. Guess what? If you were blowing up at 5% with X trillion in debt, and then you increase your debt, you double or triple your debt, or whatever, depends on the country or the corporate, of course, as interest rates go up, you have lower ability to pay. I can afford, anybody on this call can afford a $1 trillion mortgage at 0%. But at 0.1%, it becomes a different issue. So this move up in Q2, in the fourth quarter 2018, showed that this process of normalization of monetary policy had limits. And since then, we saw a very preemptive central bank. And then we saw, obviously, March 2020. Now, the move was huge across the curve. But what we've seen more recently is this massive steepness of the curve, where once again, the back end is leading. But look at the 2-year. The 2-year has not blinked. And the overnight obviously remains, virtually zero. So the Fed, in the words of the Federal Reserve, they're not even thinking about hiking interest rates, right? Yet the back end is telling you, hey guys, inflation's coming, so I want more compensation. And also it's telling you all this fiscal will have to be paid somehow. Your ability to replace is going down, so I want more premium. The debate on inflation, and I think right now the Fed is calling for inflation to be transient, transitory, short term. I think the bluff will be called later in the year, and you will see that this inflation is not just a blip, it's something more real and bigger. And in that sense, we'll see the reaction from the central bank. But this very steep curve, there's been a lot of debate on how high can this go. My view is obviously it's a function of the duration in the system. So if your mortgage is at 3-month LIBOR floating plus X, you shouldn't really theoretically care about the 30-year rate. You just care about where the 3-month is going to be over the next 30 years. Even if the expectation in the market is that you're going to pay a lot more, for the time being, you can still breathe. The water is manageable. Once short-term rates start to go up, then the water level goes up and a lot of people will drown. And this is, again, part of the reason why you see so much issuance, governments and others trying to lock in these attractive long-term rates. But something's going to give in my opinion. And I think what's going to give in is that long-term rates will go down. I don't see how this convergence with short-term rates going higher. Perhaps this steepness remains for a while, but I think the issue is and the convergence will happen more the other way. And the reason, or one of the big reasons, is equity duration. I mean, we've seen how this move in long-term rates has resulted in the collapse of fixed income, particularly long-dated. So 30-year treasuries down 22% since the summer. But then you see the Nasdaq and taking off despite, in a big way, despite the move in long-term rates. And I challenged this last month. I do it again because what happens is when you argue about the value of equities, a lot of people would agree with me. I don't know if anybody would disagree, but equities are expensive in absolute terms. There's absolutely no parameter, no question in terms of the fact that equities are expensive in absolute terms. But a lot of the argument in favor of equities is the risk premium, the equity yield relative to fixed income yield. And we wrote a piece, my colleague Alfonso did a nice piece on this, where we talked about equity duration and effectively the problems with the current computation. You start, people calculate the equity yield, which basically tries to compare equities and fixed income as apples with apples, and when they're not. But the effort to compare them apples with apples leads them to compare the S&P with 10-year treasuries. That's not apples with apples, because in our opinion, the duration of the S&P is closer to 30 years than 10 years. It's actually 28 years. And in the case of the Nasdaq, we think the equity duration is more like 40 or higher. So when you actually compare the yield in the like-for-like between equity and fixed income, you see that there's no premium in equity risk premium. Now, the market has and continues to completely disregard this with a lot of momentum. And as I said earlier, the move down in volatility, I think it's contributing to this. And it's literally sucking a lot of people into a trade that I think it's dangerous, but it's at the same time hard to call the end. These things, go until they stop, and when they reverse, sometimes they do it very viciously, violently. So a word of caution with what it means, this move up in interest rates, and ultimately I think that the duration of these equities is something to watch for. So a word of caution there, and why we've been recommending to take profits on or partial profits on equities and add into goalkeepers, and that the reason why we launched Aqua. Going back to the technicals, we see the S&P at the top of the, in fact, getting out of the Bollinger Band with a bunch of magenta lines and overbought levels with RSIs of 72, which, pretty much every single time we've seen that level of overbought level, we've seen meaningful corrections to follow. So a word of caution also from the technical side on the S&P. Going back into the strategy, it has been and remains an extremely difficult environment for us. I remain highly convicted to the strategy and the way we are playing things and the opportunities and how we accumulate. But it's been difficult from a factor perspective. We were hoping to do this and perform with our duties, which haven't been tested for a while. These defensive abilities, the market has been pretty much one way, and I always like to compare and as a team player to bring Igneo alongside with equities. And what we see here is the avatars almost mirror images of each other, and the team being a good team where the goalkeeper hopefully is and will be there when it's needed. So the performance of the basket, of a passive basket, a 50-50 basket, it's much more is the combination of the two. Instead of just having $50 or euros in each one, what we always recommend is to rebalance the portfolio. So this is a time, in my opinion, where you should be taking partial profits on the equity and accumulating on the goalkeepers. And we've seen these periods, this zigzag reversing. We haven't seen a peak to trough this big in the two of them in a long time. I mean, it's pretty brutal, and I think these are opportunities to accumulate. We discussed Aqua, the 80-80 strategy. That basically, my view is, if you are long S&P, you have $100 in the S&P. By selling that and buying Aqua, you still own 80 in the S&P, which will be the ESG futures of the S&P, and the other 20 buy you 80 in goalkeepers. As I mentioned before, one of the things I really like about Aqua is that both the striker and the goalkeeper are long inflation. And for the avoidance of doubt, this is not changing in any way the way we manage Igneo. In fact, we only manage Igneo. Aqua is just a simple pari passu exercise where we will do 80% in S&P, 80% in Igneo, and monthly rebalance. So this is not a deviation in a strategy. We're not trying to do things differently. On the contrary, what we're doing is we're creating an instrument that some of you, Scandinavian Pension Fund, asked us find easier to implement than running the two pieces separately. So if any interest or any questions, please let us know. Going into the portfolio, I think pretty much everybody in this call is familiar with the construction, the 50% in precious, 30 in treasuries, and 20 in options, where the options, we only buy options. So we're net payers of premium every single time, where we buy calls on anti-bubbles and anti-crisis, we buy puts on bubbles, and we try to keep those percentages relatively stable, which means that hostile periods when the options do very well, we'll take profits on the options and accumulate gold and treasuries. Periods when perhaps like now the market is very benign, very bullish, then the opposite happens. So the idea is to keep the strategy as balanced as possible, and then within those buckets to try to deploy the capital in the best way possible, mindful that we're buying insurance in a one-way street, which has been painful. So in that sense, looking at the components of these insurance buckets, there are a few clear candidates: long gold, long treasuries, long tips, long dollar, long volatility, both short-term and long-term, so gamma and vega, long inflation, short equities, short credit, which we do mainly via puts, and then combinations of these pieces, such as, which include correlation between gold and equity, emerging market, commodity currencies, developed currencies, etc. This is the attribution of the P&L in absolute and monthly pieces. We see how the more volatile components have been the options buckets, both for good and bad. And we see in more detail the detailed attribution with, again, periods of big gains on those buckets and others with more losses. Going into more specifics, we see a current snapshot of the portfolio in terms of premium at risk. A good friend of mine tells me off every month for having these numbers as negative. He thinks they should be positive because they're assets. This is the premium of things that we own. So but I like to put them in negative because this is the potential maximum loss scenario for this snapshot of the book. And what you see at the top is a summary. The bottom is a little bit more expanded. In both cases, the same data. We have about 22.7% of the AUM in options at the moment, of which a very meaningful portion is linked to gold. So that exposure to gold directly through calls and also through other insurance is basically part of our view. You see that we're diversified also through time, even if our exposure in options in 2021, it represents roughly about half of the option book. So we have quite a few things that expire, the gold calls and other things that expire later in the year, because we feel there's a bit of a sweet spot in those points. If we think about the payoffs, not just the vanilla options, but also more exotic payouts, which I'll discuss shortly, and more hybrid, which include correlation, we also try here to find the right balance. Vanilla options are fantastic. If you can buy them cheap, happy days, do it. The problem is sometimes the premium is too high, the carry is too high, and therefore the asymmetry is not so attractive. So trying to monetize the skew as we do for gold or S&P or the correlation, there are ways in which we can cheapen the premium and hopefully reduce the carry and increase the payout. Let me give you some examples of this. And this is a very simple profile, which is a vanilla option for gold. What you see, the vertical blue line is where the spot price is at the moment. The green line is the payout at expiry of this insurance program. And the red and yellow lines is the mark-to-market of this option at different points in time. What you see on the left-hand side when gold is low is your option is out of the money. If the market finished there, the options would expire worthless. And what you see is that the time value that you paid, so the red line, as time goes by, becomes the yellow line and eventually becomes the green line. So this option gives you a profile where you're long volatility, you're long gold, but you have negative carry. And the question is, you can see your break even, which is a point where the green line touches the horizontal axis. That's how much the gold price needs to go for you to recover your money, your premium. So options are great because they give you limited downside and limited upside, but you need to make that money back, and you need to, bleed through time value. So one of the ways in which you can fight this or improve this profile is take advantage of the contango, the term structure, the skew, and is to generate insurance with this kind of profile. Now, this effectively combines two pieces. It combines the vanilla option, and then what you see is that if the gold market was to go up massively, in this moment about 2,300, then you will give back some of the gains. The interesting thing about this is the probability of gold hitting 2,300, according to the contango of the futures, the volatility, the skew is meaningful. And then what happens is you actually can get some money back, which it does many things. It reduces the premium because you pay for the vanilla and you sell the other. In a scenario where gold goes super high, you will make money yes or yes or yes. You just happen to make a bit less because you give some back. But overall, you make still significant money. But also, you see that the carry takes a very interesting profile. So if the gold price was to stay low, the option will remain negative carry. But as the market goes up, and I think our sweet spot right now would be to go back to sort of all-time highs, which to me is pretty much the base case for gold for the next few months. It's just a matter of time. But in this case, what you see is that the red line becomes the yellow line, becomes the green line. Effectively, the book becomes very positive carry. Again, for the time being, this has been one-way street, gold under a lot of pressure. So for now, we remain moderately negative carry on the gold side. But I think this profile can change very significantly as gold goes up, etc. So we like this type of payoff. The other thing that we've done is we've taken advantage of this move down in gold to reduce the premium. If you saw this graph last month, the actual strike for gold would have been, in this particular option, would have been 2,000, and the barrier would have been at 2,600. What we've done is, as gold went down, is we spent a bit more of incremental premium to basically reduce the strike and also reduce the upper level. For gold to hit 2,300 would be a very good scenario for us, but we've now improved the recovery and the payout. Instead of going above 2,000, lower levels. And this is part of the reason why the strategy has been suffering, is as gold goes down, you are effectively spending more money beyond the original premium, but you're using that to hopefully improve your position, so that if things do turn around, which in my opinion is a matter of time, then you actually get to participate earlier, and we will be taking profits and restructuring the book. So if you just stay passive and you let those options, at those very high levels, effectively your sensitivity to the price disappears. You become, if you just bought your 3,000 puts on the S&P or your 2,000 calls on gold, you need these big moves to make your money back. We are willing, and I think it's the right thing to do, to spend more money at the expense of potentially losing it, because gold could go to zero, S&P could go to infinity, but the reality is we think this is the right way to do this. In the case of the S&P, we run effectively a mirror image. Instead of buying the call, we run a put. The skew is super elevated, and this is a real trade in the books. We bought 3,800 puts for December, and then effectively we sold the 3,500 put, but the 3,500 put only exists if we touch 3,000. And so a scenario where the market goes down moderately, and there are reasons to believe why it may not be an utter collapse, and part of it is we have more room now with interest rates. But in my view, as the market sells off and these options start to pay, you might see also treasuries going up, gold going up. So overall, in the portfolio, I think this fits very, very nicely. And you see again the carry profile, how it changes from a scenario with higher equities or a scenario with lower equities, where effectively, as things start going our way, our strategy becomes significantly more positive carry, which makes life a lot easier. For the time being, we're fighting, we're in the back foot, but I think this is the right approach to continue to accumulate. And I know some of you on the call have done some meaningful increments recently, so thank you. I think it's the right thing to do to those who can. Obviously, the drawdown has been meaningful, very painful for everybody, myself included. But we're doing what we think is the right thing. So move up in gold would hopefully bring us significantly higher, and a move towards maybe all-time highs. I expect would bring us pretty close to high watermark. So we'll see how things play out. Time is going by, but we are optimistic. I highlighted last month one trade. Actually, this is exactly the slide I used last month. The market's moved a bit since in our favor, but it's the idea, and we're starting to see some noise with China and Taiwan, and also Biden announcing overnight, these concerns with dependence on semiconductors, shortages, and making a $50 billion commitment and getting everybody in the US. I'm actually surprised this hasn't happened before, but ultimately we think Taiwan will be a big bone of contention. China we've seen them acting in Hong Kong, and I think this is something to watch. Now, when I mentioned last month that the hedging of Taiwan dollars, all this massive amount of demand for Taiwanese products on a forward basis means that the corporates are willing to lock in their margins by hedging the currency, and that has resulted in massive positive carry for us, for people who are effectively looking to hedge the tail risk of an event in Taiwan. Although who knows in which direction the currency would go, but volatility would clearly increase. So the combination of the term structure, the volatility, means that you get really good odds for buying this type of hedge, which we have in very sizable amount of payoff. So relatively small amount of premium could make a meaningful P&L. So this is something, again, we're not just trying to stop the shots from the S&P or gold or the VIX. We are also careful in monitoring other big risks in the system, including geopolitical, and I think Taiwan and China are big. In the case of China, a big credit bubble, and I think a lot of issues with the currency. I think Taiwan is going to be interesting as well. With that, I'm going to leave I think in terms of time, we still have time for a few questions. So I'm going to, let me see if I know how to do this. I'm going to stop sharing the screen and open it up for questions. So if there are questions, please shoot them over. I can see there's one already. I'm going to stop sharing the screen. If you have more questions, please post them. The first question comes, how do you recommend capital allocation between gold, GDX being an equity index, physical miners, as a hedge against inflation? My personal view is, gold and gold miners are both great. It does depend on the price level, on the valuations. At the end of the day, the gold equities are equities. But we don't claim to be experts on that front. There are fantastic funds and teams I can connect you with. My good old friends when I was at Old Mutual, now at Jupiter, I think are best in class. So if you want to play the gold and silver mining game, I think that's worth having an allocation. I think when it comes down to gold and gold derivatives, personally, I see a lot of value. I've always called for some of the potential issues between gold and gold miners as taxation risk, expropriation, nationalization, which is something that the managers surely take into account. But overall, the answer would be, I think they are all complementary. As you can see, we favor gold, treasuries, and options, and on the option side, we're favoring more exotic payouts and correlation payouts, although we have some vanilla. But the pure vanilla option is quite expensive. A 3-year vanilla call, from memory, you're probably talking about 18%, 15 to 20% premium. So call it 18. At those sort of levels, it's a huge amount of premium. Even if gold went up by 50%, you're barely making 2.5 to 1. So it's not asymmetric enough. And on top of that, you have big negative carry. So I think doing things in smarter ways that try to offset some of that, I think makes sense. Any more questions? I see there's still quite a few of you on the line, but any more questions? If you could please put them on the chat. Okay, here they come. Do I expect hyperinflation as well? The hyperinflation, loaded question. Yes, but it's going to depend on the country. We've already seen people like Venezuela obviously suffering it. We see how countries like Turkey are facing a lot of problems with inflation, and that's you've seen a little bit like in football, where the coach gets fired every other week. You get the central bank being fired every other week in these countries because they know what they need to do. They need to fight inflation, and when they do, and they put rates higher, then the government doesn't like it, and there's a big conflict. So what we see is effectively the central bank working for the government and taking short-term measures which effectively lead to inflation, and they do that with the hope that things will not accelerate too much, but they always do. And the solution is more of the same, and it's very, very difficult to reverse. So countries like Argentina or others it seems to be quite structural. So yes, we will see hyperinflation. We will see it in some countries first, and I think it's an issue that might accelerate, and we'll see how far and how bad it gets. But it's going to depend. What's the current carry overall? We have been running, the last few months have been particularly negative because of the moves, as I discussed. The portion of the market where we are, both on the equities as well as the gold, as well as the VIX, means that most of our options are basically in negative carry territory. We have had, and I raise my hand, a view that there are a lot of red flags that put me in alert, and so we've been also long options on the VIX, some of which have expired in December, in January, in February, in March, in April. This contributes negatively. Good decision, bad outcome. Bad decision, bad outcome. I don't know. We're honestly trying to do the best we can with these processes, and we're actively reassessing. So we have recently shifted some of these incredibly painful into other ways, such as the S&P options I discussed. So we remain negative, but a bit more moderate. And if gold recovers a bit, I think the book should be flat or even positive carry. But at current levels, will remain negative. If every single option in the book was to expire worthless, as we are now, you could see 7 to 8% from here to year end. That doesn't mean every single option will expire worthless, but we have premium at risk. So that's the nature of the game, and it's what's been costing us, and we've been suffering. A lot of the losses in the NAV are unrealized losses, so they are effectively options that are still alive, even if the expectation of them paying out today is lower and the value might be lower. They're still alive, and I think that we'll see how the markets evolve. But personally, as you can tell from this call, I am highly cautious, and I think that many of the things we're seeing are highly distorted. So hopefully, a matter of time that things normalize, and that, in the case of gold, means higher, which for us will make a meaningful difference. There's another question, and are your options typically at the money or out of the money? Is there a minimum asymmetric return? Yeah, we tend to average payouts that are 5 to 1, 10 to 1 at entry. So if you spend 1% in a digital, or $1 million in a digital option, we would buy for about 10 cents. So 1 million would pay us 10 million on the event. We don't wait till expiry for those options. We tend to exit in stages. So we sell 1/3 when we're 3 times up. So you're left with 3 options, and as the market goes up, we take profits. Otherwise, it would create a huge amount of risk, because we like to buy things at 10 cents that can pay 1. If the option is now worth 90 cents, I can only make 10 cents to lose 90. So that it goes a little bit against our spirit. But yeah, they are, some of the options in the book now are 40 to 1, like the gold versus Taiwan, and they're not that far on, particularly in the Taiwan. They're now 1, 2, 3% away to justify such huge payout. The reason they're that asymmetric is because gold is lower, and also because the term structure and the volatility is such that the mathematical models they think in terms of forwards as they should, but the carry in some of these trades is very flat, and gives us huge asymmetry. So it does change, but generally we like to enter things that are at minimum 5 to 1, but on average maybe 10 to 1. Okay, it's 20 past. If those of you who are keen to stay on for the Spanish one, we'll start in 10 minutes. Otherwise, I hope you found the discussion helpful. If you have any questions or you'd like to have a one-on-one, please let me know. I'll be happy to arrange. And I want to thank everybody for your time and your support. Extremely difficult times for all of us. Not enjoying this particularly, but we try to remain as balanced and focused with the view that hoping to make the right decisions, which I think we are. With that, once again, thank you all, and much health. Speak soon. Take care.